can I take the loss today against active income, being a real estate professional, or can I take the losses against passive income that generates through other passive investments, gain on the sale of an asset that's a passive investment?
Welcome back to Keeping It Real Estate, where we bring some real conversations with real people who are shaping the future. We have Tim Gertz on with us. He is our CPA firm that we worked with for years from Provision, and he is a strategic thinker and very tuned into the tax law, and has been an absolute unbelievable team member for us here at Granite Towers Equity Group. One thing in real estate before we start talking with Tim is it's a team business. It's a team game, and best team in real estate wins. And I can't stress enough how important it is if you're a real estate investor, a syndication firm, and you're looking to build your wealth, to take the time and get the right CPA on your firm. They're not all created equal. It's one of the biggest changes in my life from my snowboarding career. Transitioning to my full-time real estate career was hiring Provision and Tim and helping guide me to make the healthiest decisions to create the future and wealth I was looking to create. So Tim Gertz, welcome to the show. Great to have you back on again.
Yeah, thanks. Glad to be here.
Yeah, you guys, I'm going to stress it one more time, just how critical picking the right team member is. Core value fit, helping you to get to the goals you're looking to create. This is a long-term vision, someone you want to work with for a long time. And Tim and Provision, they handle all of our tax returns for 100% of our properties. And being on time with accurate K1s is going to make or break a lot of your investors' opinions about you. So make sure you're choosing the right one. And if you need to reach out to Tim, I'm sure he'll open up how to get a hold with him later. So Tim, biggest thing that we want to talk a little bit about is this big, beautiful bill. It's passed. 100% bonus depreciation is back. What does that mean, do you think, for the real estate market? Let's just talk a little bit about the changes you foresee coming because of this bill being passed.
I mean, ultimately what it's doing, as you've seen over the last couple of years, and we talk about it all the time, is bonus depreciation started to phase out. And so that idea, and especially with the current interest rate market, people were doing a lot less leverage to be able to make deals work. So now you not only have less leverage, but you have more cash in the game, and bonus depreciation started to fall. So the tax benefits weren't as aggressive or as attractive as they used to be. Bringing it back to 100% bonus depreciation is giving you the ability. Even with a 55, 60% loan to value, you're still going to see an 80% deduction in that first year, which is huge. And bringing it back for things like car washes or gas stations, things of that nature that used to have that 100% write off in the first year outside of land, that started to phase down. Now it's right back where it was. So now you've got this ability to acquire an asset that maybe you've only put 50 cents on the dollar into, but you're getting a write-off on 90% of that asset value, which is huge.
Yeah. You guys, I just want to talk a little bit more about what Tim was just sharing here. So, bonus depreciation, it was this sunsetting clause, and Tim, correct me if I'm wrong anywhere here, but basically it was 100, then it moved to 80 and then 60. And so we were not able to write off as much year one as we had used to been able to do. So we weren't able to show as large of losses. And obviously that when you're looking for losses in real estate, if you can't get as big of a loss, you start looking to other asset classes. So what really this bill has done is it's put fuel on the fire, if you will, to give you larger losses year one. So now you have more capital potentially coming back into real estate and chasing real estate, which, it could be what signifies the bottom of what I would call the real estate cycle, because the last few years in multifamily have been pretty painful. Like Tim alluded to, a few years ago, you're buying with bridge debt with 80% leverage with your CapEx financed, and really you're over leveraging the deal. You might be getting some great write-offs, but you're so levered. And with a variable rate loan, they all start to rise as interest rates rose. And a lot of those deals are now hitting the market because of the strained debt. Too much debt hit it. So, what I'm excited about is we're in a state right now with real estate where we're buying deals with 65 to 75% leverage, which is a pretty good levered amount from my perspective. And you're able to get some pretty large losses because the losses have been down so much over the last couple of years. So, Tim, if someone's looking at real estate and they're looking for losses, what qualifies them to be able to use the bonus depreciation to offset their income?
I mean, it losses no matter what you're able to utilize it. It's just when you're able to utilize it. So it's just a function of, can I take the loss today against active income, being a real estate professional, or can I take the losses against act or passive income that generates through other passive investments, gain on the sale of an asset that's a passive investment. So there's this whole, and I know we've talked about this before, there's this whole idea and thought process of, oh, well, if you can't use the loss, you can't use the, why are we doing a cost segregation study? We can't use it. So why are we utilizing it and passing it out to LP investors? You can utilize it. It's just when you utilize it. And I actually did a mastermind class a couple weeks ago on depreciation recapture and what it looks like on the sale of an asset and how it actually creates a tax incentive to do a cost segregation study, just simply because of the arbitrage between the deduction you're getting in the beginning and what you pay on tax in the end. So it's a thing that everyone can utilize. A lot of people say IRAs can't utilize losses from depreciation. That's incorrect as well. IRAs utilize depreciation, and IRAs actually are things that need depreciation more than individuals because their tax rates are so low. As far as their marginal, the individual tax rates are all marginal based. So, you as an individual, if you make $100,000, you pay tax at 12%. You go up at 22, all the way up to 37%. In this situation with a trust, which is what an IRA is, you're paying tax at 37% above $12,500. So individual $350,000 to $650,000, you start paying 37% tax. An IRA, once it gets over 12.5, it's paying 37% tax. And depreciation can't offset that income. So it's very valuable.
Wow, I want to touch back on the IRA. That's news to me. I was not under the impression that an IRA could utilize depreciation. So I want to talk more about that. That's huge. But before we do that, you threw a term in there, a real estate professional. That was new to me at one time in my life during my snowboarding career. And when I learned about what that was, being married, we were able to position ourselves in a way to qualify as a real estate professional. So, if listeners are hearing this for the first time now, can you explain, in layman's term, what that is and how potentially a couple could qualify as real estate professional and what that would do for them?
Yeah, definitely. So there's a code section 469, which is passive activity losses. And it dictates what you can take again, passive losses against active income. Real estate is inherently passive. It is considered a passive activity no matter what, unless you are a real estate professional. And at that point, it converts it into a trade or business that you can then materially participate in. So if you're married or not married, the test is really you've got to spend 750 hours in real estate related activities. They're pretty broad in what that means. And then you have to do that more than any other income producing activity that you do. So me as a full-time, work in provision, I'm full-time in provision. I would never be able to be a real estate professional because even if I spent 750 hours, I'm not going to spend 2,500 hours doing real estate because I spend 2,500 hours doing provision work. So in your situation with your wife, we were able to say, okay, well, your wife is not working at this current juncture, your snowboarding career. How about she starts doing real estate? How about she gets actively involved in the real estate? How about she is the one that is managing all these deals and working with the acquisition teams and doing that? I mean, in that situation, we were able to look to her 750 hours, and she didn't do any other income producing activities. So she is a real estate professional. At that point, now all your rental real estate is active because she's active in it, and your active income can be offset because now your losses from real estate are active as well.
Yeah, you guys, I just want to reiterate this story because it was one of the most powerful realizations and things that I was ever taught. And this was taught by Tim in Provision about what to do. So, my wife and I, I'm a professional snowboarder, traveling the world. It's this awesome career and I'm loving it, making good money. Meanwhile, my wife is working at Red Robin and I come home regularly and she's in tears. And I'm like, what's going on? And she's like, I hate working there. And I'm like, well, you don't need to work, and B, there's this new idea, Melissa, if you would like to manage our 16 units, being we're married. And if you go and manage them and you spend the time with the accountant, you spend the time with the manager, you oversee the CapEx and you basically are managing, it qualifies a real estate professional. So she got excited about it. She was like, that sounds amazing. Like, that's fun. And so she got into it and we tracked her hours and boom, all of a sudden you qualify as a real estate professional, and allowed me to invest the money I was making as an athlete into small multifamily deals. I bought a 9-plex, I bought a duplex, we bought a 24-unit deal. And as we invested the capital in that deal, we did these cost segregation studies, which were done by a professional firm, relatively inexpensive and is paid for with the help of, properties performance. And boom, you mix that with your tax return and you have a beautiful loss. That's, it's not a real loss. It's on paper. It's a loss, and it helps you legally pay a little less in tax. So if you're in a position right now where you're making great money and your wife, or vice versa, your husband isn't excited about what they're doing, it may make more sense. Like, it made more sense for us to go and become a real estate professional than for Melissa to keep working at Red Robin. And it was more fun for her. So did I explain that okay, Tim? Was
Yeah.
that accurate?
Yeah, and that's the powerful thing. And I have a lot of conversations. You mentioned two things that were very powerful. Number one, because of her focus in real estate, she was able to qualify as a real estate professional, which then gave you the opportunity to offset your income and not pay taxes, to then snowball that into more properties, which then solidified her as a real estate professional, because now she's got 50 properties she's managing, or 50 units that she's managing, which then again creates more opportunity to offset more income, which then snowballs that up, and it continues to go and go and go. And on top of it, you start to look at, and I had this conversation a lot, like the Red Robin example. My wife's not my wife, but clients have, oh, my wife's a receptionist. She makes $50,000 a year. Well, does she like doing that? No, she doesn't. Well, with all the real estate you have, if she becomes a real estate professional, she'll be making $150,000 a year because of the tax benefit that creates. And so you're able to essentially take someone out of a situation that is miserable to them, put them in a situation that they enjoy, and it is a return on benefit, return on it. It's just
Yeah.
incredible.
Win-win, you guys. So I'm curious for you, Tim. You're not a real estate professional, and I know you invest in a lot of multifamily, a lot of different investments that give you depreciation. So do you have just a war chest of depreciation ready to go, or how are you utilizing the depreciation?
Yeah, I mean, ultimately, the goal with passive losses is to find passive income generators. So, is it you either have this war chest that continues to grow, and I talk about that all the time. Like, just because you can't use it today, it carries forward until you can utilize it, or you pass away, and hopefully you utilize it before that happens. So, it gives you the opportunity to explore options. It gives you a better opportunity to potentially be able to offset taxable income from gains on sale. So, I have a war chest from 15 investments, and then my 16th investment sells for 3 times what I invested in it. I'm not going to pay tax on that because all the other losses are going to offset that. On top of that, once you start to have that passive loss war chest, then you start looking at, okay, what else can I invest in? Are there passive businesses that aren't capital intensive, things that are going to throw off passive income? And I have this, passive loss over here that I can just pull in. So maybe I'm not making hordes of money off of that passive investment, but I'm not paying tax on it. So my return on that passive investment continues to grow because of the tax-free, implications of it. So
That's great, you guys. So, but as we talk about the 100% bonus, when will it go away? I mean, is it going to
it,
go?
Well, it's permanent. Permanent. It can be voted away. Yeah, as long as it's not introduced into another bill and passed, then it will be permanent forever. I don't see this ever being something that gets revoked. It's bipartisan. It's always been bipartisan. If you remember, it came out of 2002. So Bush put it into, the legislature at that time, introduced it. It got passed into law. It went through different iterations. It went through different administrations. Even if you remember, in 2023, the extender bill passed the House with bipartisan support. It passed. That would have brought back bonus depreciation to 100% in 2023. It went to Senate, and the Senate didn't think that it would help their cause to get the administration changed, so they squashed it. And so it has the support. It will always has had the support. It's more of a, it's a tactic. It's a, how can we utilize it type of thing. But I don't think anyone's ever going to come back and be like, this doesn't make sense. Because if you think about it, and I can go into like super technical detail on this, but it's aligning the cash outlay to the tax implications of that cash outlay. So let's get debt out of the picture. Let's say you go and you buy $1 million property and you don't have bonus depreciation and it's a commercial property. You get to deduct that $1 million over the next 39 years. So you just lost $1 million. You gave $1 million for an asset, and that asset is going to depreciate, and you're going to get 1/39th a year for the next 39 years. Well, you're going to have income off that property, and that income is going to be taxable. So now you're paying tax on income from an asset on after-tax dollars that you no longer have. So by aligning that and being able to say, I went out and bought this $1 million asset and I can write it off in the first year, I'm essentially taking the after-tax aspect of the dollars I spent on that asset and deducting it. And so that's the whole, our whole conversation is real estate related, but you got to think a little bit more granular in it because it's the personal property within the real estate that is subject to bonus depreciation. So it's the things you can pick up. It's, for lack of it, it's my cell phone. It's the desk I'm sitting at, the chair I'm sitting at. It's the, dishwashers, the refrigerators. They're trying to align the outlay of capital to buy equipment with the ability to take a deduction so you're not paying tax on that capital in the year that you outlay it.
Yeah. Do you see, because of this change, that this reignites, the real estate market to a certain degree, mixed with who knows where rates go? Maybe they come down, maybe they don't come down. Do you think that this is something that could signal the bottom and have capital coming back into the markets?
I don't know.
Okay.
Honestly, you would think that it is that. I don't know if it's enough to do that. I don't know if it warrants. I mean, me, my whole adage is never let the tax tail wag the dog. Yeah. If it's still not a good investment because cap rates are at a level where you're break even on your interest rates, then it doesn't make sense as an investment. So, I think that there's got to be other shifts. Where are we in the economy? Our interest rate, our rent rates going up? So
yeah. What's your take? I love speaking to you, Tim, because you do a lot of research, a lot of reading. What is your take on where you think rates go over the next 12 to 24 months? Do you think we stay flat, down, or up?
I have no idea.
Okay.
I couldn't tell you. I mean, I couldn't tell you. I think I've always, we've talked about this in the past. Historically, over the last 50 years, from an average rate standpoint, we're still pretty good. I think the average is like 5.5% or something over the last 50 years. And we're 5.3%, somewhere in that ballpark. So we're right at the average. The question becomes, what does it do to, the inflationary aspects of the dollar, and what do you want to do to the dollar? Because you can slam interest rates down to zero, but the buying power, all you're doing when you drop interest rates is you're giving people the ability to borrow to buy. And so now they don't need as much dollars to buy because they can borrow money from someone else and buy. and so that creates a deflationary. From a value standpoint, the dollar value goes down, inflation goes up. Other way, it creates So I don't know.
Yeah. Okay. Well, I appreciate that insight. My take, and take it for what it's worth, which isn't worth much probably, is that there, if we do see rates come down with what Trump's looking to do with Fed, new chairman, if it does happen, my take is it's not for a long time. Only because it seems to me when we're looking, one of the things we're looking at when we're buying deals is new builds coming. How much new product is coming? What competition is going to do to our rents? And so there was a lot of new build happening in 21 and 22 because rates were so dang low. Apartments were going nuts. So everyone was building as fast as they could. And then, as rates rose, we're seeing less new builds in some of the markets we're looking at. This is not, I'm not talking countrywide here. I'm talking in specific submarkets we're looking in. We're buying a deal right now where we can see the new supply is dropping off a cliff. And so my thought, and I see it with our residents because a lot of our residents are Hispanic folk and they work on construction. And a lot of them have had a harder time in the last 2 years. And so from my take of what I can see, taking the news out, we're seeing things slow down. We're seeing a lot of our folks that are generally very comfortable in the Hispanic space struggling more. And we think it's because construction has stopped quite a lot and there's less jobs. And so, with that supply demand issue, I think more product is needed badly. And I just got a message. And I don't know if you've read about this, Tim, but there's a new bill that's going through the housing. Have you heard anything about a bill that's going to reignite low income housing?
Not yet.
Yeah. Okay.
Not yet. There
It's
was a part of the one beautiful bill that had the low income housing tax credit.
okay. Yeah. So going wrapping where I'm going here is I think if there is a pullback that it will hopefully get building going because we're short on housing in
Mm-hmm.
America. And it's a serious problem, and it will give a lot of jobs put back into place. But the problem foresee, just like Tim is talking about here, is as soon as that happens, asset prices start to go up,
Mm-hmm.
and you're going to have a lot of compression in cap rates again, and it'll allow people to start buying quickly. And how do you handle that? In a touchy spot right now with where we are in the debt cycle. I love Ray Dalio's book, how Changing World Order. If you haven't read that book, take a look. He verifies some very key metrics, and he looks back at the last 1,500 years of when empires or countries rose and fall, and what they measured as they were rising and falling. And a big one is the amount of money printing. And as we all know, there's just an incredible amount of money printing. And where's the dollar headed? So, all that to say, I'm a big component of gold and silver and real estate and cash flowing assets, things that you can touch, things that are real. Tim, do you have any thoughts or insight of what you're doing with currency, capital on the side? What's your focus during these kind of tumultuous times?
I mean, as interest rates go up, then interest rates in interest bearing accounts, things of that nature go up. I mean, you've got a lot of growth in precious metals. Crypto is kind of a little manic right now, but it's definitely gone up a lot. I mean, I think you can't always, cash is king, but cash is also deflating. So you've got a situation where your dollar today in a cash account is not worth a dollar tomorrow. So you've got to kind of look at what that is. In the past couple of years, you could get 5.5%, and in a lot of the investments that you're seeing out there, they're saying 5.5%. So why would I give money to make it illiquid for an asset that's going to return the same amount that gives me an opportunity to be able to acquire in a time when things turn around, or if we hit the bottom and things are turned around? So, I mean, I think there's a lot of alternative investments. I think there's a lot of manipulative investments. I think the stock market is highly manipulated. So you've got to be extra cautious for that. I think the long-term growth assets, the real estate, like you said, precious metals, that stuff is a good investment in the long term.
Yeah. Well, I wanted to go back to one other point you said. Never let, I think you said, the tax tail wag the dog. Is that how you put it?
Yep.
Yeah. Let's just talk about that for a second for our investors that are listening. What does that mean?
I mean, ultimately, a lot of people, and I've heard it, like tax is king. You should always do everything based on taxes. Like if you can go out and buy $1 million property and get $375,000 tax credit because you write it all off, do it. But at the end of the day, if that investment's a dog or you lose that investment, you just lost 63 cents. So you always have to look at what is the investment outside or independent of the tax benefits. And I always say the tax benefits are the cherry on the top. If you don't like chocolate and someone gives you a sundae and it's just a double chocolate sundae, are you going to eat it? Are you going to like it? Or is it something that you want? If it's not something you want, then why are you going to ever use money to buy that? Now,
Yeah.
if it's a mint chocolate chip sundae and you love mint chocolate chip, if someone throws whipped cream and a cherry on top, you're going to be like, oh, it's even better now. So, I mean, that's the way I think about it is you can't look at the cherry only because what's underneath the cherry is what really means anything. And if you're going to lose all your money because you're putting it into an investment, it's worthless.
Yeah. That said so well. I think that's an analogy to keep close in mind, investors, is think of the depreciation as the cherry on top, right? Like you just said, you might get your 38% or whatever, 37% tax deduction, but if the investment goes to zero, you just lost 63 cents. So I love that as far as, making sure that you're investing into a quality asset with a deal sponsor, like and trust, do your due diligence. And one other question I wanted to just kind of tap your brain on, then I do want to wrap up with the IRAs, but are you investing now into real estate, or are you in a hold pattern to wait and see, or what's your philosophy with where we are?
I'm always looking for investments, what they are. I think it just there's still a lot of speculation. There's still a lot of I have the same fears like you had said. If interest rates dump, it's great, but now we got compression, and now you've got whether or not they're sustainable because now in order to get that value add principal, you've got to increase rents. And can the people that are in your apartments actually afford those rents? Or is that growth now unsustainable? So it's kind of one of those situations. I'm kind of I think everyone is a little bit gun shy at this point, but I think it's more of a looking at what kind of real estate it is and what the viability of that real estate is. Everyone had talked about self storage. Self storage is king. Self storage is great when the economy is good. Self storage is great when the economy is bad because when people are moving, they need a self storage facility. When they're losing their properties, they need a self storage facility. But self storage is kind of stagnated. And we're in this situation where self storage really isn't a great investment at this point. So it's just kind of getting a feel for where the market is going. I think the biggest holdback for me on investing is what's going to happen with the interest rates.
Yeah, yeah. I want to touch on what you just talked about a little bit, Tim. Like one thing that we've learned over the last few years of seeing multifamily go through some challenging times is picking the right tenant profile can make or break you, because you're managing, at the end of the day, your customer is your tenant profile, and whoever lives in that submarket is going to be your customer. And knowing your customers' habits, what they can handle for a propensity for rental increases, and having clarity on that, I think is a separator of putting yourself into a deal that could perform or could go bust. So one thing we're spending much more of our time on and working with some extremely high level data research teams, actually family offices that invest with us lately, is a clear understanding of who is living on site and their ability to handle rental increases. And what's happened is we've got together alongside a family office that is purely looking for great investments. And we're on this trajectory of growth over the next decade. We've been around for about a decade, so we've gone through some pain, and we're building our team, and we're setting our sights over the next 5 years. And when we get alongside someone who can give us the data of who's living on site, and we get a clear understanding of about what they can handle for rental increases, it's just another piece of data to say, yeah, let's go this path, or let's dodge this potential bullet. And so we're buying a little bit newer product lately, like 2000 or newer, potentially 2000, 2010. It's got a little value add, and in submarkets where the tenant profile really cares about their credit. care about their future. You're in a position where you can get into a schooling system where you're the top school or the top 3 schools in the state. You can buy in those submarkets with pent up demand, fix your debt, because that's a huge variable. Tim, I'm with you. And like, where are interest rates going? And if we can get ourselves into a cash flow position with minimal rent bumps, or they're already getting rent bumps, that gives us a lot more confidence in saying, hey, let's go this direction, get the bonus depreciation on top of that, and ideally hit a base hit. And if we get a little luck and interest rates do come out down, or we get a little more rental increase, maybe it turns into a little home run. So I appreciate your insight there, Tim, and I always appreciate your insight too, because when the big beautiful bill was passing, you got all these people online who are saying it's done, it's over, and then it just wouldn't happen, and you'd be over here being like, yeah, it's not going to happen as soon as they think it is. So a great voice of reason and a conservative voice for our team. It's always been appreciated.
Yeah, definitely. I mean,
Yeah.
you got to wait until it's signed into law to jump on it. So
Yeah. Yep. So last point I want to touch on is the IRAs utilizing depreciation. So tell me, how is it that a self-directed IRA can use depreciation?
So you've heard of UBIT and unrelated business income tax. That is any exempt organization, whether it's a nonprofit or an IRA, which is considered an exempt organization, is subject to UBIT. So if you've got to look at what the business does. So if a nonprofit is helping homeless people and it goes out and it starts putting on theater, that income is unrelated to their cause. So then it's unrelated business income and it's taxable. Same with an IRA. When you look at an IRA is an investment vehicle. So any investment you make in something that spits off portfolio income, interest, dividends, capital gains, is exempt from tax, because that's its purpose. It's an investment vehicle. If you invest in things, and a lot of people don't know, if you invest in like oil and gas is a trade in business. So it is a business. It is not an investment. So in the eyes of the IRS, if you invest in oil and gas in an IRA, all of the income that investment kicks off is subject to unrelated business income tax. Another piece of unrelated business income tax is debt financed income. The IRS says if you use anyone else's money to generate income within a IRA, it's subject to tax. So real estate has leverage. Mm-hmm. So if in the year of sale, or even let's just say you do low leverage, or you go buy something with cash and it does kick off income every year, if you then lay debt onto that and you are kicking off that income, whatever that percentage is, if you're 50-50 leverage, 50% of that dollar is going to be subject to tax. Well, depreciation, again, it's the same thing. You have revenue, you have mortgage interest, you have taxes, you have operating expenses, and you have depreciation. It's not bonus depreciation because you can't take bonus, but it's straight line depreciation. So no different than, if you didn't do a cost segregation study. But it will offset unrelated debt financed income. So that's why an IRA needs it, because if they don't have that depreciation, they could be in a situation, if it's a 80-20 or 70-30 loan to value property, where they're paying tax on 80% of the money that they generate in income.
Yeah.
Does that make sense?
Yeah. So you're saying that if an IRA has an investment, they can take the depreciation, but not the bonus depreciation?
So there's different depreciation systems within the tax code. There's alternative depreciation system and GDS, general depreciation system. Anything onshore is subject to GDS. So and GDS has bonus depreciation in it. Anything that's offshore, so anything that's not on United States soil, has to use ADS, and any exempt vehicle has to use ADS. So they can't take bonus depreciation, but they can take straight line depreciation because it's an exempt organization.
Wow. This is why, you guys, it's important to hire a great CPA. Like, I'm hearing what Tim's talking about, and I probably could re-record it or re-listen a few times to really dial it in. But that's the beauty of hiring great team members, is you don't need to know it all to this level that Tim is talking about here. You hire people who are unbelievable, who are highly skilled, who are obsessed with the tax law to help educate you, teach you, and put you in a position to legally be as efficient as possible as you build your wealth. So, Tim, I really appreciate you coming on the show again. Is there anything else that we should have talked about that I missed?
No, I mean, I would just keep an eye out for, as things progress, we're still in the infancy of this bill. So in the life cycle of a bill, you've got legislature that writes and passes it, then it gets signed into law. Then after that, you've got a period where the IRS interprets the law. So the IRS will start releasing what are called regulations. Those are really the interpretation of the law. So there's a lot in the law that is still unknown. We've got the framework for it, but we don't know how it's actually going to play into action. So we're waiting on the regulations to get released. So just as time comes, you'll get more information. And if we need to come back and do it again, I'll do it again.
There you go. Well, again, you guys, thank you for listening to Keeping It Real Estate. If you think this should be shared with anybody, please don't hesitate to share it. And if you think there's anybody that would be great to have on our show, send us a message. We'd love to invite them on. And if there's any topics you want us to talk about and address, please share that in the comments as well. Tim, if people wanted to reach out to you, what's their best way to reach out to you at Provision?
They can just send an email to contact@provisionwealth.com, or they can go to our website, provisionwealth.com, and there's a contact us tab up top.
Thanks, you guys, for listening. We'll see you next week.
Thanks.